All right, welcome to this technical explainer. Today, we're making a massive and frankly super exciting transition. If you've ever felt just completely frustrated as a retail trader, trying to figure out exactly when to buy or sell a stock, only to watch the market do the exact opposite of what your indicators promised, yeah, this is for you. We're going to decode the technical analysis behind the smart money concept. We're moving you away from all that retail frustration and right into deep, actionable, institutional insight.
So why do your stop losses keep getting hit? Picture this. You analyze the market, you find that perfect support line, you buy your stock, you set your stop loss safely below the line, and then bam! The price suddenly drops, hits your stop loss, kicks you entirely out of the trade, and then, of course, immediately reverses and shoots right up, just like you originally predicted. Why does this happen constantly? Well, the tough truth, the market might actually be manipulated against you. Large institutional players deliberately set traps to capture your capital, literally using those sudden reversals to their own advantage.
To really grasp why this happens, just look at this number, 70%. That is the massive chunk of Forex trading volume controlled purely by smart money. We're talking central banks, hedge funds, and the massive financial institutions. And while that specific 70% figure highlights currency markets, the exact same institutional dominance dictates how you buy and sell stock. These institutions don't just participate in the market, they literally create the market. So tracking their massive institutional footprint through technical analysis, it isn't just a neat little trick, it is absolutely critical for your survival as a trader. So to get you trading alongside these giants, here is our roadmap for today. 1. Decoding smart money intentions. 2. Mapping the market structure. 3. Identifying institutional order blocks. 4. Spotting fair value gaps. 5. Locating liquidity traps. And 6. Executing your SMC strategy. We're going to take all this complex jargon and break it down step by step into a cohesive, highly mechanical trading strategy.
All right, let's dive into Section 1, Decoding Smart Money Intentions, Lifting the Institutional Veil. Think of this entirely as a detective story.
There's a really stark contrast between traditional price action and the smart money concept, or SMC. Traditional price action relies heavily on historical chart patterns. You're drawing basic support and resistance lines and kind of just blindly reacting to them. But SMC, totally different philosophy. SMC traders look much deeper. They're analyzing institutional order flow and liquidity dynamics. They aren't just asking what the price is doing, they're actively analyzing why the price is moving. Specifically, they're looking for where the smart money is actually going so they can buy and sell stock right in tandem with them.
Moving on to Section 2, Mapping the Market Structure, Finding the Footprints.
To actually trade alongside the major players, you first have to understand a break of structure, or BOS. This happens when the price pierces a key level of support or resistance, setting a new high or a new low, and decisively breaking the former ones. Basically, a BOS is your primary technical signal confirming that institutional momentum is driving the current trend forward. It's the shift from a market correction into a full-blown impulse move, signaling the general direction we should be looking to buy or sell.
When you're visualizing this, notice how the price forms a series of lower highs and lower lows. Each time the price pushes past that previous lower low, it creates a break of structure. It totally validates that the downtrend is strong and intact. We aren't out here guessing the trend. The smart money is literally printing the trend for us through these structural breaks.
But hey, trends don't last forever, right? That introduces our next concept, the change of character, or CHOCH. This is an abrupt shift in the market's behavior. A sudden change in price action, volatility, or volume that suggests the current trend is weak and a reversal is highly possible. If a BOS confirms a trend is continuing, a CHOCH is your early warning system that smart money is getting ready to reverse direction, which means it might be the exact right time for you to exit your position.
Which brings us to Section 3, Identifying Institutional Order Blocks, the Smart Money Entry Zones. Now we focus on where these huge trades actually happen. Think about it. Institutions can't just dump billions of dollars into a stock all at once. It would cause massive panic and give them terrible prices. Instead, they use order blocks. These typically show up as a temporary ranging or sideways market. It's basically a condition where these giant financial players quietly accumulate or distribute massive quantities of an asset through several big orders without creating crazy volatility. For an SMC trader, spotting this footprint is huge, because this specific area establishes a clear, high-probability entry and exit zone for our own trades.
Next up, Section 4, Spotting Fair Value Gaps, Market Magnets. So when smart money finally unleashes those massively accumulated orders, it creates incredibly violent market movements. And these moves leave behind structural inefficiencies that we call fair value gaps, or FVGs. An FVG is a unique three-candlestick pattern, where that middle candle has a huge body, representing a rapid price drop or surge, and the wicks of the first and third candles just don't overlap. The market essentially moves so fast that pending orders were left completely unfilled. And here's the kicker. These gaps act like powerful market magnets. Because institutions always seek to balance supply and demand, the price is almost always drawn back up into these FVG zones to rebalance before the broader trend continues.
All right, Section 5, and this one is absolutely crucial for your survival. Locating liquidity traps. Don't be the prey.
Remember, smart money needs immense liquidity to actually fill those massive orders. And where do you think they get it? Often, directly from retail traders' stop losses. Think about common retail liquidity targets. Trendline liquidity, buy-side and sell-side liquidity, double tops, double bottoms, equal highs and equal lows. Do those sound familiar? These are the exact patterns that traditional retail traders are taught to trust as safe support and resistance zones. But to smart money, these are just obvious clusters of resting stop-loss orders. They are prime targets. Institutions will intentionally push the price just past these retail safe zones to trigger all those stop losses, harvesting the liquidity they need before reversing the price into their intended direction.
So how on earth do we enter a trade without falling into those exact same traps? We use the optimal trade entry, or OTE. This is a highly refined retracement zone, usually found using a Fibonacci tool, situated specifically between the 62% and 79% levels. By waiting for the price to retrace deep into this premium or discount window, often right after a liquidity grab has just happened, we find our high probability safe entries. It keeps you from chasing moves, and it makes sure you're buying undervalued stock and selling overextended stock.
And finally, Section 6, executing your SMC strategy, the actionable playbook. Time to bring it all together.
Here is your exact, step-by-step procedural approach. Step 1. Determine the trend by looking for clear breaks of structure or a change of character on higher timeframes. Step 2. Identify those high-probability order blocks where the market makers are clearly prepping to execute. And Step 3. Wait for confirmation. Check that a fair value gap exists for the price to retrace into, and confirm that a liquidity trap has already been sprung, wiping out the retail traders. Once those three conditions are met, boom, you have a strict, mechanical entry.
I really want to leave you with this empowering thought from our sources. Well, the good news is that we don't need to compete. We can instead learn to read the signals these investors leave behind and change the rules of the game. Look, we don't have the billions of dollars needed to compete with hedge funds or banks, but we don't need to. We just need to technically analyze the undeniable footprints they leave behind. So let me ask you, now that you understand how to identify smart money entry and exit points, and you can actually see this matrix of liquidity grabs and order blocks, are you going to keep trading blindly against the smart money? Or will you finally start trading with them?